Look, we have full employment, 3.9%. We have more people trying to find workers than there are workers that are available. That gives labor and workers pricing power. However, their real income, adjusted for inflation, if wages are increasing around 4%, inflation is running at the number that we see right now, they're actually losing money. So it hurts the lower scale workers in particular. And you just have to make sure that inflation doesn't destroy their income and their buying power and undermine the economic growth of this country.
Some of the other things we've been talking about, Richard, is one, it sounds somewhat hawkish, but they didn't do it immediately. They seem to Powell seemed to downplay a 50 basis point move in March, which may be called for. That's one side of things that maybe they weren't as hawkish as they seem. The other that I find is that there's no guarantee that they have the fortitude to follow through if there's some type of a market break that they can say will hurt the wealth effect. And we don't know for sure whether they have whether he has feet of clay or the Fed has feet of clay. Do you believe them and you believe where the dot plots indicate what's going to happen now? Do you believe it? Will they follow through?
When I joined the Fed in 2005, we're in the middle of a rate increasing cycle. It ran for 14 different turns consecutively under Alan Greenspan. I think market operators should look at that history because it took a while to then dent inflation because there's a lag and when monetary policy impacts the economy. They know this. They're going to have to proceed deliberately. The worst thing you want to become if your chair is Arthur Burns, who let things get out of control. And so at the same time, you don't want to squash the economy. The markets, this is why I believe they're being so gradual and deliberate and telegraphing what they're going to do so that the markets can adjust. But let's face it, Joe, I want to come back to the alcoholic metaphor we started with. The market's been wearing beer goggles for the longest possible time. Everything looks beautiful because money was free. And they just assume the Fed's going to bail them out. I think the strike price on the Fed put has moved significantly. And unless we have a dramatic turn in the markets that indicates it can infect the real economy, I don't believe, under this chair in particular, who has a credit market background, that they will be weak in following through with what they've pronounced.
I don't know about that beer goggles. That may have been canceled, I think.
I used that years ago, and I feel it the same way today.
It could have been either way. I used to hope.
Even you look good, Joe, with beer.
I used to hope the other people were wearing beer goggles, but they weren't, unfortunately. So we had Druckenmiller say now we can believe it again and then believe the bond market again. Then we had a discussion, maybe the bond vigilantes will be back. And then I thought, you know what, if the bond vigilantes did come back and inflation really is hot and gets hotter, then things could get out of hand quickly if they vote with their feet. And then you worry, you know, that growth could slow. You cut off the expansion. Inflation gets out of hand. We raise rates. It could be a bad scenario if the bond vigilantes come back. Maybe they should, but it's not pleasant when they do.
No, it's not. And actually, we push so much money out into the marketplace that the Fed has less control than it did in the old days. But the yield curve is telling us already we're going to get 4 to 5 moves. We'll have to see. And the bond vigilantes have a lot of power. However, there's a lot of room as well, Joe, because we're fully employed. We have more people trying to find workers, as I said earlier, than workers available. And this growth number that just came out, it may be revised a little bit, but it is astonishing. No one expected something this strong.